Okay, what if I told you the entire goal of investing isn't to win? What if it's just about staying in the game? In this explainer, we are going to build a super simple, calm, rule-based system that is designed to keep you invested for 30 years, maybe even more. It's all about surviving first, so your money has the time it needs to really, truly grow.
And the way we do this is with a 5-part system. It's our playbook, a baseline portfolio, an optional tilt, some protective filters, preset tripwires for when things get crazy, and automated rebalancing. You master these 5 things, and you are set for the long haul. Because remember, the goal isn't to beat the market, it's to stay in the market. So why do most portfolios actually fail? Let's be real, it's not because of one bad stock pick, it's because we get psychologically broken. We get forced out of the market at the absolute worst time, selling everything at the bottom because you have to, or just because pure panic takes over.
And there's a reason for that panic. It's baked into our DNA. All the research shows that we feel the sting of a loss about twice as hard as we feel the joy of a gain. Our brains are wired for survival, right? Not for getting the best possible stock returns. This system we're building is designed to work with that reality, not fight against it.
And I promise you, by the end of this, you will know exactly what buttons to click inside your brokerage account and the one single metric you need to check each quarter to make sure you never, ever get pushed off that cliff.
All right, here's the roadmap. This is how it all fits together. We start with a baseline portfolio, then we'll look at adding that optional tilt. After that, we set up our survival filters and our tripwires for the scary days. And then we put the whole thing on autopilot with rebalancing. Let's do it. First up, and honestly, this is the most important part of the whole system, your baseline. Think of this as the unshakable foundation of your entire plan. It's built to survive the chaos, so your money has decades to do its thing and compound.
Your choice here is pretty simple. You can go with an 80-20 split, that's 80% global stocks, 20% global bonds, if you want a bit more growth. Or you can do a 70-30 split if you want a slightly smoother ride. The most important thing, just pick the one you know you can stick with for the long haul, even when things get rocky.
And here it is. This is the secret weapon, the thing that makes it all work. A separate cash buffer. We're talking 3 to 6 months of living expenses sitting in cash, totally separate from your investments. This is your fortress. This is what guarantees you are never forced to sell your long-term stuff just to pay for groceries during a downturn. Now, when you build this baseline, you have to be absolutely ruthless about costs. You're going to use broad, low-fee index funds or ETFs. I mean, you should be aiming for an average fee of less than 0.20%. Fees are just a quiet killer of your long-term returns.
Okay, on to part 2, the tilt. And this is totally optional. Think of this as your little bit of spice. It's a small, very controlled way to bet on a theme you really believe in without, risking your entire financial future on it.
But we've all seen this happen, right? How does a supposedly small bet spiral completely out of control? It's a classic psychological trap, and honestly, almost every investor falls into it at some point. You know the cycle. Something gets hot, you hear everyone talking about it, so you chase the returns, and then boom, regret. It's called outcome bias. When a bet actually pays off, our brain tells us we're a genius, not that we got lucky. So what do? We pour more money into it, usually right at the absolute peak.
So here's the rule, and it's non-negotiable. Your total tilt, all your small bets combined, is capped. 5 to 10% of your portfolio, period, full stop. You decide this ahead of time. If it grows past 10%, you sell some. If it drops below 5%, you can buy a little more. The rule makes the decision for you.
All right, let's talk about our defense system. These are your filters and tripwires. They're here to protect you from those hidden risks, but more importantly, they protect you from your own worst impulses on a really bad day.
Think of this as your pilot's pre-flight checklist. Simple stuff. Rule 1, no margin, ever. You just can't play a long-term game if you can get wiped out by one bad call. Rule 2, keep any single stock to 5% or less of your whole portfolio. We already talked about fees, keep them under 0.20%. And always fill up your tax-advantaged accounts first.
Now these tripwires, they tell you exactly what to do when your brain is screaming panic. If the market drops 20%, what do? Nothing. You let your automatic buys keep on running. If your job suddenly feels a little shaky, you pause adding to your tilt and you build up that cash buffer. And if your portfolio drifts 5% away from your target, you rebalance. Simple. The decisions are already made.
Okay, now we get to the best part, making this whole system totally effortless.
You're going to set it up once, and from then on, you only have to track one simple thing.
Here's how you do it. This will take you maybe 10 minutes. Log into your brokerage account, set up an auto deposit from your bank account every payday. Then set up an auto buy for your 80/20 or 70/30 funds. Make sure that little box for reinvest dividends is checked. And last, go to your calendar and create a recurring reminder every 3 months that just says, check drift. That's it, you're done.
So, that calendar reminder pops up. How do you actually do this check-in in just 5 minutes? What is the one thing you are even looking for? This is it. The only number you care about is drift. It's just your actual percentage minus your target percentage. So if your target for stocks is 80%, but they've grown and are now 85% of your portfolio, your drift is plus 5%. That's your signal. That's the trigger to rebalance. No emotion, no guesswork, just math.
And look, if you have a partner, this is your script. Seriously, say this out loud together. It gets you both on the same page about the real goal. You're not trying to look smart at a dinner party this year. You're playing a much bigger, much more important game. You let the rules decide, not your moods.
So, let's do a super quick recap of the entire rulebook. You've got your baseline, 80/20 or 70/30, and it's protected by that cash buffer. You have an optional tilt, but it's capped at 5 to 10%. You have your survival filters like no margin and low fees. You have your preset tripwires for when the market goes nuts, and the whole thing is automated, so you just have to check your drift once a quarter.
And that brings us right back to the most important question. Because the best portfolio in the world is the one you won't freak out and abandon. So which one is it for you? 80/20 or 70/30? What's the allocation that's going to let you sleep at night? Let me know down in the comments.
And as always, remember this is just for educational purposes. It is not investment advice. If this system brought you a little bit of clarity, do me a favor and hit that like button and subscribe for more explainers that help you get smarter. Thanks for watching.